Hello, everyone. My name is Hunter Smith with Metastock. I want to welcome you to this week's international market recap. Today is Friday, January 17th, 2020. It's crazy that it's already 2020. I'd like to welcome you to the studio in snowy yet sunny Salt Lake City, Utah. We're excited to be here today. Today's market recap, we have a very special guest, Mr. Arno Venter. He is a senior commentary analyst for Forex Source. He's actually worked for Jarret Davis for a couple of years now, and essentially he's one of the educators there. What we're going to be doing today is we're just going to be focusing on primarily the Forex market. And we're going to be getting kind of a good idea of what's happened this last week, what to look for next week, discuss some different things that might be causing the market to be doing what it's doing right now. I'd like to bring on my special guest, Arno. Arno, can you hear me okay?
Loud and clear, Hunter. Thank you so much for having me.
Yeah, it's a pleasure to have you here. Boy, I tell you what, kind of getting into, well, first off, you're in from Joburg, is that correct? Outside of Joburg?
Yeah, just about an hour's drive from Joburg, yeah.
Wonderful. Well, it's a big time difference, so I really thank you for being up at 11:30 at night and having your wits about you to talk a little Forex.
Yeah, we'll see about that. We'll see about that. Thanks for having me again. It's a privilege being here with you guys.
Well, wonderful. First and foremost, I'd like to just kind of talk about the Forex market as a whole this week. I started opening my charts in Zenith, and there was a lot of red there. Very few markets moving up right now. What are your thoughts on what happened in the Forex market this week?
Now, this week was an interesting one. I mean, we tend to view currencies in two spectrums. The first one is the overall more fundamental view. And in terms of that one, we'll take anything from a month to a 3-month quarterly view on a specific currency from a fundamental standpoint. That takes things into consideration like your economic data, your monetary policy, mainly focused on growth and inflation and how that affects policy as a whole. And then obviously in the short term, the more sentiment-based moves from whether that is big deviations in certain specific data points that we get, or whether it's maybe risk sentiment. I mean, we've seen a lot of ups and downs this week. I think the interesting one for us this week was the move that we saw in the dollar. At the start of the week, we had the dollar pretty much selling off with no clear fundamental reason behind it, no clear sentiment for it. And we did have a slightly better than expected retail sales that came out that gave it a little bit of a lift on Thursday. And then in today's session, we did see it carry on that initial momentum that we saw on from Thursday, mostly driven by the weaker pound. The pound is definitely something that we'll discuss in a little bit more detail. And basically the dollar and the pound being two of our key themes right now from a fundamental point of view. And I think a lot of the red that we're seeing across the board, across the currency space, especially the majors, has mostly been it's a dollar-based move. With that strength in the dollar, we are currently more bearish on the US dollar in terms of a fundamental bias. So in the sentiment, obviously didn't see that playing out this week with the data we got. So I think the most red that we got was mainly dollar driven at this stage.
Yeah, I would agree. One of the statistics that I read was that U.S. housing information came up. It's up 16.9% from December, and a bunch of new loans getting put out there, a bunch of new construction being put out there. So I think that could be one of the driving factors here. U.S. jobs, our job market's been relatively strong this last quarter. And I think that might be part of this late push. But I keep kind of going back and forth on it, primarily because of the trade disputes right now, which seem to kind of be weakening a little bit. In other words, the Chinese economy is relatively strong right now. The U.S. economy is showing some strength here. What do you think about the 18-month tariff war that we've been in?
I mean, you know what, for us that primarily trade shorter time frame. So what we tend to do is we like to have a fundamental bias that gives us a quarterly view on a specific currency, whether that is a specific theme like the dollar or the pound. And then we like to trade around that core position in the shorter term. So looking for key data points, looking for key events to basically trade in line with that overall fundamental bias. Now, something that's really that's been a whipsaw for us over this whole trade dispute has been risk sentiment. I mean, risk sentiment is a key factor that we consider in our trading. And you know, before all of this happened, it was, I don't want to use the word easier, because I mean the markets are never easy, but it was a lot simpler. And you tended to see trending moves in terms of risk on and risk off. You tended to see a lot more sustainability in certain moves like that, especially if you're trading a specific risk on a risk off move. And what we saw with the trade dispute, and what that basically caused us to do and change in our own methodology, is basically looking for much shorter time frames to take advantage of certain moves. So we would normally have a fundamental and a sentiment bias lined up. Normally we could have, you know, left that thing running for a couple of sessions, sometimes maybe even a week or more. And even now, when we take a fundamental based trade, I might close that down in a session's time or 2 sessions time, basically just taking advantage of that short-term moves, just because of that volatility that we've seen from the trade war. So it's been a bit of a roller coaster, a lot of things to get used to, that's for sure. But I do think we're entering a different phase now, pardon the pun, but a different phase with the trade dispute. I think both sides needed this phase one in the short term. There's obviously lots of political reasons for why both sides wanted it to get done as well.
Mm-hmm.
But I think for us, it should give us a bit of a breather until the market starts to realize that phase two will be a lot more difficult to sort out with all of the IP issues that's there, and some of the underlying issues that really is the reason why they decided to split it up into the phase one and the phase two. So as long as the market doesn't think about it, I'm happy for now.
Right.
Not really wanting to get involved in all that. So when I heard the Chinese say earlier this week that they're really in no rush to get back to the table, I thought, okay, thank goodness, at least we can trade economic data in a little bit more confidence.
Everything kind of going back to
term.
normal, right?
Yeah. Well, we'll see. I mean, we really do hope so. Really do hope that's the case.
Now, the relationship between the U.S. and the Chinese, you know, I know quite a few Forex traders that don't even really bother trading the yuan pairs whatsoever, and it's almost not even considered a major pair, basically. But when looking at the relationship of the two countries, the U.S. Dollar and the Chinese yuan, what other markets do you feel? What other currencies do you feel are directly affected by that relationship?
The biggest one at this stage that we've seen, and obviously due to the risk factor, has been the 3 commodity-based currencies like the Aussie, the Kiwi, and the CAD. So those 3 are normally your risk-on movers. They can be expected to appreciate during your risk-on sentiment, mainly based because they are considered as riskier assets. And obviously, then on your safe haven side, your risk-off currencies would be your yen and your Swiss. And with even though the Kiwi and the CAD, as well as the yen and the Swiss, all of them are affected, the Aussie has been affected the most out of all of them, just because they have a very close relationship in terms of trade with China. So if you look at the trade volume between them, China consists about 40% of Australia's business. So whatever affects China will heavily affect the Australian dollar, also having a transmission effect into the Kiwi dollar as well. And when we have any major disputes between the US and China. Obviously, that'll affect your safe havens in the short term. But I think out of all of them, the Aussie was the one that was hit the hardest in this dispute. And for that reason, we might see a little bit of an unwind of some of that negative positioning on the Aussie dollar if everything does eventually start to peter out a bit.
Wonderful. The British pound. They have a lot going on. You know, they've had some news come out, and you know, are they leaving? Are they not leaving? It's been up and down for quite a while now. Their currency has been on a strong upward trend, I would say, at least above the 200 period moving average since October. What do you think?
Well, I'm very glad you asked me about the pound, because it's definitely one of our main themes at this stage. And what's exciting about it, it's a very new one that we're looking at this moment. Obviously the dollar as well. We can talk about the dollar as well, but specifically the pound. Obviously, we had the Brexit referendum in 2016, and if we have a look at the pound, most of the downside we saw in 2018 and 2019, a lot of that was dollar driven. With the dollar appreciating across the board against most of the majors, and we'll get into some of the reasons why. In terms of the pound, a lot of it was dollar, but a lot of it was that overall just uncertainty about what's going to happen. Like you said, are they going to leave? Aren't they going to leave? We've had changes in the government. I mean, we use the audio squawk. And right at the height, when everything was just going extremely bad for the pound, right before we had that initial rally, I mean, you kind of we got numb on the audio squawk from just listening everything about Brexit. Then it's this guy saying, and then it's the EU says this, and the UK says this, and then this guy says that, and the opinion is this, but the economy is going to fail. No, the economy is going to flourish. It was just hectic. I mean, a lot of uncertainty going around. And obviously that first push we saw up to the upside in October, that was from the final breakthrough that the guys had with the withdrawal agreement. So Boris Johnson coming in, playing a little bit of a hardball there, getting a deal very similar to the one that Theresa May had. So very similar one, but I mean, eventually he got it through. That saw that initial first push to the upside. Then we had a little bit of a consolidation period in the run-up to the general election. And then obviously that last push we saw in December was from that election gains. Now, the most exciting thing that we think about the pound, obviously we have seen the pound give up some of that election gains, mostly due to the hardline stance taken by the UK government now with the December 2020 transition deadline. And what the markets are basically, the reason why we saw a lot of pullback from that election gains is just because the market is now starting to reprice the possibility of a messy Brexit again. Because, I mean, if you look at the history of trade deals, if they get it done in, well, it's now, 11 months, it's going to be something, you know, getting a trade deal done, especially one that's so intricate like the relationship between the UK and the EU. The market is telling themselves, listen, either the UK doesn't want a deal, or they have something that the EU desperately needs, and they have some sort of leverage that we don't know what. So we have seen some of that election gains being given back on the back of that uncertainty. Now, something that is exciting that happened is we know that the Bank of England wasn't really in focus for the last, let's call it 2 years. Mainly because everything was around Brexit, was going about Brexit. And in terms of the Bank of England, the market didn't really focus on monetary policy, didn't really focus on economic data, because everything was about Brexit. Then it was about the withdrawal agreement. Then it was about the election. And basically, all of that changed pretty much in the last week or so. We know that the economy was slowing. The UK economy was slowing. It was slowing enough for 2 of the MPC members to vote for a rate cut. Normally the MPC has 9 members, and 2 of them did actually vote for a rate cut in the 2 last meetings that we had in 2019. So we knew the economy was doing bad, but again, the market didn't really focus on that. And what happened recently is we had Governor Carney coming out last week, and he had some pretty dovish things to say. So he basically said that they did expect growth to slow, but growth has basically accelerated to the downside a lot quicker and a lot more than they initially anticipated. And currently, the MPC is busy deliberating whether the effects of additional stimulus and easier monetary policy will have a positive effect in the economy in the short term. So that was some pretty dovish things. Didn't really see a lot of downside in the pound from those comments. But the day after that, we also had another MPC member. It was Tenrero coming out that she also is opting for a rate cut or in favor of a rate cut due to the issues in growth and the labor market. And over the weekend, we also had another MPC member, Vliga, coming out saying the same thing. So we had the two dissenters that voted for a cut. And now we basically have three other members also saying that they are considering cuts. So that started to reprice the probability of a potential cut by the BOE. At that stage, we had, I think, about a 20% probability for a cut in the January meeting, which is in about 2 weeks' time. But this week, we had a couple of interesting economic events. If we just have a look, we had GDP, the month-over-month number coming in below the market's minimum expectation. Year-over-year number stayed flat. We didn't see a lot of impact initially from that GDP event. Did have a couple of output numbers coming out negative as well. The interesting one was yesterday's CPI. So CPI has been trending lower for quite some time. I mean, if we have a look at the year-over-year core metric, it's been trending lower from 2017, and it's moving in the wrong direction very fast away from that 2% BOE target. So that was like just another nail in the coffin. And I think after the CPI event yesterday, we were up to about, I think, 56% probability of a rate cut as soon as the end of this month. And then obviously today we had the retail sales numbers. Now, retail sales were interesting. One of the silver linings for the UK economy was the consumer. The consumer was doing pretty well. And basically kept growth afloat. And this miss is basically putting a little bit of a question mark on whether the consumer will be able to boost growth as much as they needed to. I mean, during December, as well as the Black Friday in November, that data was actually pushed into December as well. So if you consider everything that should have gone well for them in December, it doesn't look well. It doesn't look really good in terms of the consumer, seeing that retail sales numbers missed across the board. Now, after this came out earlier today, I think currently we're sitting at about a 71% probability of a rate cut as soon as 2 weeks from now. So that is a very dovish shift in the short term for us in terms of the pound. So we have a fundamental bearish bias based on the fact that we're repricing the chances of a messy Brexit, and now suddenly the BOE is back in focus and possibly looking to cut rates at the end of this month.
Yeah, and from a technical standpoint, looking at the pound, the pound was here in March, April. It was right around the exact same area. It created kind of its own support for quite some time, resistance actually. We're right around the exact same price point, and it just seems like there's a lot of indecision, and especially with the consumer information coming out. I just don't think that people are confident enough to spend money there, and that's what drives the economy, right?
Exactly, and I mean, I don't blame them. I mean, they were very positive after the election, and then suddenly with the majority, the government said, you know what, that transition, we don't really want an extension. And I mean, writing it into law, it's a big move. It's a bold move. I don't know whether it's a bluff. We'll need to wait and see. But I think there's definitely more downside, especially now that the BOE is back in focus as well.
I agree. Greg, we had a question from YouTube.
Yeah, you have a question from Ruben Rex on YouTube. He says, what is the best strategy when sentiment keeps changing in the blink of an eye?
That's a good question.
You know what? When you're trading in the short term, it's always a tricky approach trading the shorter term sentiment, because like you said, it can really change in the blink of an eye. The way that we basically weigh out that in our day trading approach is basically making sure that we're always pairing the strongest with the weakest currency in any particular trade environment. So let's say, for example, the pound, we're trading the pound and we have a bearish bias on that fundamentally. We get something like retail sales coming out, and then we look for other clear, fresh catalyst drivers in the short term, that we compare a strong currency against that weaker one. So that obviously gives you a little bit of a higher probability off the bat. So looking at today's chart specifically, we had a trade idea on the pound Aussie directly after the announcement of the retail sales, just because we had that overall risk on sentiment in the market. We saw that the Aussie was strengthening across the board and expected that to continue. But I mean, the challenge is you're sitting in a risk on environment and you get a tweet about trade wars, or you get a very negative comment from a US official or from China, and suddenly the risk sentiment changes. It's unfortunately with the trade dispute, that's really been something that we've learned to deal with. One way that we have done that, like we said previously, was to make sure that we're not eyeing 100 and 200 pip moves on something like a sentiment-based trade. Happy with cutting that down to a lot smaller targets, just trading from key support and resistance areas in the very shorter time frame. And I'll say the quickest way that we manage that, or risk manage that, especially seeing that the sentiment can change quickly, is just making sure that you stay in tune to any potential changes. So obviously for us, when we trade risk sensitive currencies like the Aussie, the CAD, and the Kiwi, or the Yen and the Swiss, we do have all the markets open in real time. So we're looking at the equity space, making sure that everything is still in the green or still in the red, depending on the risk sentiment. And obviously staying in tune with the audio squawk helps us a lot. So we normally get whatever potential news can change the sentiment very quickly. We'll get that information instantaneously. It gets squawked out, and that gives us enough time to react. Obviously, sometimes you won't get the opportunity to close a trade for a profit. Sometimes you'll need to take a smaller loss to avoid taking a much bigger one by just letting things run. But yeah, for me, the way that we manage that is making sure that nothing changed, staying in tune with the most relevant feed items that gets fed across the audio squawk. And I mean, then just using basic risk management techniques. I mean, when trading these type of moves, we tend to use a lot less leverage. So on moves like this, we'll probably look for things like anything from 1-to-1 to 1-to-2 leverage, making sure that we stay safe with regards to risk, that we're not over leveraging and then we get a tweet or something goes haywire very quickly.
Now let's take a look here. Let's talk about the CAD for a second, because obviously it's very, very intertwined. You were touching on it a little bit earlier. I'm looking at a chart, and again, I'm a little bit more of a technical based traders, but we want to cover a couple of bases here. In this, it has bounced off of its 200 period moving average 3 times since it looks like July here. It seems to be, I mean, the 200 period moving average has kind of turned. It's kind of peaked and turned to the downside. What are your feelings on the CAD right now?
I'm loving your questions today, Hunter, because it's all stuff that we're currently looking at. So I really like the question about the CAD. The CAD is one that we're really interested in at the moment. If we have a look at the CAD specifically, we have seen that the economy is doing well. We've had a couple of blips in terms of the economic data. We had some labor reports that didn't come out too positive. Not the most recent one, but the two before that actually came in a lot weaker than the markets were expecting. Now that started to beg the question about whether the BOC would need to put in place some sort of a rate cut or easier monetary policy as soon as, I think a lot of market participants were expecting January of 2020 already. And what basically happened is we saw the BOC actually coming out and pouring a lot of cold water on that idea, because the main concern for the BOC was actually the trade dispute. I mean, they've mentioned that so many times in their statements and in their press conferences, saying that that for them is the biggest concern in the short term, because they are a commodity-based currency, very affected by global trade. So that was the biggest concern. And what they said in the December meeting was that even though that was a big concern, they do feel that the trade dispute was moving in the right direction. I mean, at that time, we just had the announcements about the signing of the phase 1 deal and finally agreeing to most of the information that the two sides were disputing. And they basically said that because of that uncertainty being removed, they do see that the global economy will do much better in 2020. And that's obviously a very positive thing for the Canadian economy. And looking at the monetary policy, they say that, yes, they've had a few blips here and there, but inflation is still, I mean, one of the few central banks, the major central banks, that's been able to keep inflation above 2% and keep it steady. So that's really a positive one for them. And in terms of growth, with all of the trade uncertainty dying down, they basically said that they still expect growth to accelerate throughout 2020 and 2021. So we are very bullish on the CAD in terms of a fundamental bias. In the short term, we have seen a little bit of an up and down, obviously, from the oil markets. Oil is a very big consideration for the CAD, a very big part of their GDP. So whenever we have major moves up and down in oil prices, that's obviously going to be something that will affect the CAD in the short term. When we had that big move up in oil prices from the geopolitical tensions between US and Iran, we saw some further appreciation in the CAD. And then obviously as that de-escalated again, we saw a major pullback in oil prices over the last week or so, or 2 weeks. And that has really seen a little bit of wind taking out of the sail, so to speak, for the CAD, but we are still bullish both in the short and the medium term for the Canadian dollar.
Definitely, and I think from our perspective, at least my perspective, I think that I'm bullish on it as well. One of the things I'm definitely going to be looking for, since it's kind of formed kind of a triple top, triple bottom situation, I'm really going to want it to break above that 1.3 mark, where it's, where the 200 period moving average is right now. 1.335. I'm really going to want to wait till it breaks above that to see kind of a longer term picture of if it's going to be bullish or bearish. But definitely in the short term, it's had a strong bounce the last couple of days. It's moving a little bit sideways right now, but I think that the case is strong that it's going to break up above where it is. Now, Greg, we have another question.
Yeah, Ruben Rex again asks, so for someone who has a day job looking to take swing trades, what should such a person be looking for in the markets?
Ruben, my guy. He's asking some good questions today.
Okay, so I mean, what we normally look at in terms of swing, for swing trades, we're not really going to be too concerned about the shorter term oscillations that we can expect. The one challenge that you're always going to have as a swing trader is making sure that you're in line with the overall fundamental bias for a particular currency pair. So if we're going to look at the CAD and the pound, for example, if we have a look at the pound CAD, that is one of the swing trade, or let's call it medium-term trade ideas that we do have a short on the pound CAD currently. So you can look to just view the broader term fundamentals to make a trade call. Obviously, the challenge with that is picking your entry. That's always going to be a challenge when you look at the more swing trades. Obviously, you can use your support and resistance levels to make sure that you're getting a good entry. But in terms of the shorter term oscillations, there's so many things that can drive the price up and down in the short term. So the thing that you just need to keep in mind when you take a purely fundamental based trade based on the medium term fundamentals from a swing trade perspective, is that you're going to need to be okay with taking on some drawdown. In the short term, you might see the market move against you based on purely idiosyncratic short-term sentiment drivers, and that's always going to be the case. But making sure that you're staying in line with that overall fundamental bias is really the best approach for us personally in terms of currency trading on a swing trade basis, making sure that the overall fundamentals are in place. And normally that should play out quite well. The challenge is just, again, choosing your entries wisely. We like to wait for a very clear short-term sentiment shift. in the market. So let's say we're looking to short the pound CAD, for example. We'll wait for a major economic event in either the pound or the CAD that basically feeds into that current fundamental bias for the pair, and they will basically take an entry from there. Now, normally you might still expect or see some drawdown on swing trades like that, but mostly it does move in your direction eventually, as long as the fundamentals are in place.
Great. Let's see, Arno, what else do you have for us? Was there anything else that you wanted to cover?
Yeah, well, I think another interesting one that we're keeping an eye on, don't really have more of a neutral bias on this one at the moment, is the Kiwi dollar. We saw a lot of easing from the RBNZ throughout 2019. I mean, many other central banks as well, but they did surprise the markets in August when they did a 50 basis point cut, when the markets were only expecting a 25 one. And now what the bank did later is they came out afterwards saying that we actually cut by 50 basis points because we were looking for a better reaction in the price. So that's not really something that you should be saying as a central banker. If you want the market
just
to
messing
sell,
with you guys.
yeah, we actually didn't want to cut by 50, but we did because we wanted to devalue it a little bit more. So that wasn't really a smart move, and that saw a little bit of a blip. But they came out again in November, surprising the markets again, basically taking an on-hold approach, saying that they are seeing a slight positive turn in the economy, noticing a few of the key data points as basically troughed, and they're expecting an uptick in most of the key data points. And if you look at the major data points that for New Zealand, what's interesting is that they've had such a bad time. The base effects actually do support a further acceleration in some of those data points. Even if the economy doesn't expand, it's not skyrocketing to the upside. You might get some upside just due to that lower base effect. So that's something positive to look out for. At this stage, we are neutral on it just because we're waiting for key data points to tell us what the RBNZ will do. There's a couple of investment banks that still expect them to cut once more in 2020. For now, we don't really share that view just because the data as of now doesn't really support it. Now, the challenging thing about Australian and New Zealand economic data is that we don't get it monthly like we do for the US and Canada, etc. We only get it quarterly. So the quarterly numbers are very, very important. If we see any, if we have a look at the Kiwi dollar, we have seen it appreciate quite a lot from October against the dollar. We would expect that trend to continue as long as the quarterly data supports it. If we see major misses in the key components like CPI and growth, that should eventually feed through to an easier policy from the RBNZ. They did say that they are willing to cut again if the growth doesn't accelerate. But we think that's an interesting one to watch out for. Mainly going to play it based on an economic event-based trades, making sure that you're trading in line with that neutral view, taking advantage of any major deviations to the up or to the downside. But that's definitely one that we're interested in as well. And then obviously the dollar, I mean, the dollar had a little bit of a perfect storm going into 2018 and 2019. There was a lot of things that added to the strength that we saw in the dollar. I mean, at this, just as the Chinese and the European economy was basically topping out in the economic cycles at the end of 2017, we saw a major boost in the US economy, making that final push from added stimulus. Obviously, we had the tax cuts and all of that. That really added to favor for the US dollar, especially in terms of the economy. And we had the Fed. That was basically the only central bank that was able to hike interest rates as much as they did after the global financial crisis. And that obviously gave us a rate differential to play with. And obviously the trade war, there was a lot of inflows into the dollar, because the moment when you have all of that uncertainty in terms of global economic slowdown, that's obviously going to benefit your dollar in the short term. Something that we are wary of, though, in terms of the dollar specifically, is that right now a lot of the easier monetary policy from other central banks have already been priced into the markets. So we've seen a lot of negative pricing in most of the majors, and a lot of that is already expected. Even the the RBA that is expected to cut again, we're not expecting a lot of downside in the Aussie dollar if the trade dispute starts to show some progress again. If they lay off on the phase 2 discussions for a couple of months, we can see a lot more upside in the Aussie dollar, we think, just because that one negative point is now out of the way. Obviously, the data will need to support that.
Sure.
But in terms of the dollar, we've seen the slowdown as basically accelerated recently in terms of a few key metrics. I mean, if we just quickly take a quick snapshot, you guys can see this screen, right?
Yes.
So just taking a quick look, I mean, we can see that really from March, April, May last year, we did start to see a slowdown in that massive run up in the US economy. And at this stage, we are printing more red across the board. So we are seeing a little bit of an acceleration in some of the downside aspects to the economic data. So that is a little bit of a question mark for the dollar. If we do see that continue, I mean, at this stage, the market still does expect the Fed to ease more in 2020, given the fact that the economic data hasn't really been positive. I mean, a lot of things are still healthy and solid, like you mentioned, the labor market.
Mm-hmm.
But there's a lot of the growth on the growth side. We've seen a lot of slowdown, and at the same time, you've mentioned China. Chinese and European data haven't looked too bad recently. There's a few green shoots. I mean, less so on Europe than on China. But if we do see a little bit of a acceleration coming in from the Chinese and the European economies, obviously that's going to boost global growth. And whenever you have a boost to global growth, that normally has a negative transmission effect into the US dollar. So at this stage we are eyeing China and Europe very closely, because a bigger recovery in those two economies, while the US is currently going through that topping process and the data is busy accelerating to the downside, we think we can see some medium-term downside in the US dollar as well, obviously as long as the data supports it.
Sure. Yeah, and pardon me, looking at the yuan, I mean, it did just dip below 200 period moving average. Stochastics are very low. It did have quite a bit of growth just recently, but it seems like that's been, definitely very stymied. So I think that as things will kind of normalize a little bit, much like Brexit, people are seeing a little bit of progress, whether it's phase 1 or the agreement for Brexit getting put off till September. It seems like things might normalize. My question to you is in the short term, what are some of the key things that we should be looking for, let's say maybe next week? There are a couple of things that you'd be looking for next week.
Yeah, next week is definitely on the pound side first. We have the labor report coming out for the pound. Now, labor is going to be important because if we get labor missing across the board, then that's basically a hat trick in terms of your three key economic pillars. So we've had GDP miss, we've had CPI miss. If we come in with a miss for labor, I think that'll really seal the deal, so to speak, for the market's probability for a rate cut. I think we can see some additional downside, or expect additional downside for the pound next week if we do see a miss in the labor data. Also watching out on Friday, we have the manufacturing and services PMI, I think, coming out for the pound. Manufacturing, not so important, but services, obviously a major part of the UK economy, contributing about 79% of total growth. So if services continues its recent, let's call it blips that we've seen, I think that'll just feed into that current negative sentiment for the pound. I think that's a good opportunity to engage next week. In terms of the dollar, to be honest, I haven't really looked at the dollar events yet. Mainly been focused on the pound. That's basically the ones that we're looking at in the short term.
Well, you never know when a tweet's going to come out, so that's kind of what we base our events on. you know.
Yeah, you know what, it's been frustrating. It's I wish we could ban market participants from Twitter.
Yeah, that'd be nice.
That'll be great. That'll be great for us,
Yeah,
just
of course.
just give us the data.
Right,
Don't give us opinions. We just want data. That's all
right,
we want to work with.
right.
But I mean, obviously, it's perfect world. We're not going to get that, so we need to be happy with what we get.
Yeah, that's true. Well, Arno, let's gonna kind of wrap up here a little bit. First off, I appreciate you being with us this evening, late this evening, your time.
Yeah.
For those of you watching, if you have questions, why don't you tell them how to get a hold of you?
Yeah, sure. Well, what the guys can do is if they have any questions, they can. I think the easiest way to get hold of us would be through support@forexsource.co. I think that's the easiest way if they want to get hold of us. Obviously, support will put them through. If they want to talk to me specifically, they'll give them the details. But I think that's the easiest way at this stage. I mean, we're also on LinkedIn. They can have a look at on LinkedIn. They'll find us on Facebook. They'll find us as well. A lot of different places where the guys can reach us.
And for the audience today, the what we're doing our analysis off of course, Metastock Real Time, Metastock Zenith, and Arno flashed a little tool that he uses up there with spreadsheets that's based off of Zenith and pulls data in as well. So if you have questions about that stuff, feel free to contact them. Support@forexsource.co. Is that right?
Yeah,
Okay.
That's correct. That's correct.
Okay, wonderful. We'll put that in the description, so if you guys have any questions, direct them there. Otherwise, Arno, I really appreciate you staying up late at night, and your wits were about you, I have to say. You pulled through really well.
Thank you so much. No, I mean, again, thank you so much for inviting us. Really do appreciate the opportunity to join you guys today.
Yeah, we'll have you back again soon. For those of you in the audience, thanks so much for joining us this afternoon, evening, wherever you are. I hope you have a wonderful weekend. And next week, as always, happy trading. See you later.